So welcome everybody to topic 10, our last topic in the course. You've made it through an entire audit and now we're just up to the summing up component. So today we're going to look at completing the audit and then audit reporting, which is a recap really because we've already looked at audit reporting. So I'm just going to give you a little bit of a refresher on that particular component. So the main chapter for this week is chapter 17 about completing the audit. And really we've spent a few weeks actually mostly looking at how we gather our evidence about whether the financial statements are materially misstated. So are the FS materially misstated? All right, and so we've looked at designing controls from a test of controls perspective, from a substantive perspective. How do we pick populations? How do we use our sampling to select some items to generate this evidence? Because remember, we have to use evidence for our audit opinion. All right, can't just go with my gut feel or what I think based on talking to somebody. I need hard, concrete, physical evidence about whether the accounts are materially misstated or not. However, there are some things that we can only do at the end of the audit, and I'm going to go through those particular areas today. So we're going to do a few different things. Let me just put my highlighter on. So we're going to look at what do we do in relation to presentation and disclosure objectives or assertions. We're going to look at contingent liabilities, because that's often an important disclosure. We're going to look at what sort of discussion we need to have with solicitors. We're going to look at subsequent events. Now that one is a key issue. So out of all of the topics of today, that one's probably the hardest one to get your head around, but there's a whole lot of materials to help you with that. We're going to look at the final steps of collecting evidence and then evaluating the overall audit results. How do I know which opinion I should give my client? We're going to talk about what we need to do when we talk with the audit committee and with managers. We are not doing number 8, okay? Because number 8 sort of links back in with number 4. I don't know why the textbook sort of separates them out, but number 4 and number 8 actually go together. So for item number 4, we're actually going to do things quite differently to the way that the textbook describes. Instead of doing what the textbook describes, we're going to follow along with the auditing standards, which is more critical. So what are we going to, so this is just a summary of what happens after we've collected all our evidence. So back here, we've done all of our controls and substantive testing, and we're going to do these things at the very end. Now sometimes this actually sort of happens back here. So it has it at the very end of the audit, but you'll actually often communicate with the audit committee and with management before the end of the audit. Okay, so the first thing we're going to look at is our presentation and disclosure objectives. All right. Remember, our presentation and disclosure objectives tend to actually cover a lot of things that we've already looked at. Okay, so there's evaluation and accuracy objective. All right, there's assertion on completeness. But the things that are really different are the assertions related to understandability. And that really comes down to saying, are my disclosures in accordance with my AASB requirements or my IFRS requirements if I'm reporting overseas? So we're saying that especially for the disclosures, are we doing the right thing? Now, the financial statements themselves, so when we look at the P&L plus the balance sheet plus the cash flow statement, is usually, 6 to 8 pages? 6 to 8 pages. However, the notes to the accounts, and who's been reading notes to the accounts for their FSA assignment? Yep. Everybody? How many more pages are there in the notes? Heaps. All right? So the notes is 30 plus pages of detailed information. Okay? So it's really important that we look at not only these numbers, but we also look at these note disclosures. Okay? That's just as critical when we're evaluating whether the financial statements are free from material misstatement. It just doesn't mean the numbers, it also means the note disclosures, because, Dan, shh. All right, the AASBs dictate what should be in the notes. How much information? What sort of breakdowns for group disclosures or segments or goodwill or inventory? That all needs to be prescribed by the AASBs. So we actually don't just look at these financials, we look at these notes as well. So what sort of things might we look at? We might need to look at, are there any contracts where we have to have collateral? We look at disclosure checklists to make sure that everything in accordance with our AASB requirements are appropriate. We look at current and non-current assets and liabilities, so that's really sort of our allocation type stuff. Now, when it comes to looking at allocation, I am a little bit worried about current versus non-current assets, but that's usually pretty easy to distinguish between firms, right? Current assets are inventory, cash, accounts receivable. Non-current assets are your property, plant and equipment, buildings, etc. But where it gets more difficult is around the area of liabilities. So current liabilities are those liabilities that need to be repaid in the next 12 months. My non-current liabilities are ones that take longer to pay. And quite often, a company might try and shift current liabilities into non-current. And that was certainly the case if you do some Googling and you look up Centro, which was the shopping centres. They misclassified $1 billion worth of debt. All right, you see $1 billion worth of debt in a massive shopping centre company that's non-current debt. You think, okay, well, that's a loan. They've got a while to pay that off. But your perceptions of that firm would change significantly if that $1 billion was in current liabilities. And that was the issue there. So Centro represented everything as a non-current when in fact it was due that very year. So in terms of presentation and disclosures, what we need to do is we need to understand our AASBs. Right, so if you thought you could leave accounting standards behind when you finished accounting standards and regulations, when you move into audit, you need to become a specialist at the accounting standards as well as the auditing standards. Now, this is not a job for junior auditors, okay? So this type of task is usually done at the manager and at the partner level, all right? And it may even be that there are specialists in your firm that will understand disclosures for specific industries. So you will have somebody who is the mining firm disclosure expert that will review your disclosures of your client to determine whether they're all done appropriately or not. Financial services has a whole lot of different requirements under AASB 9. They will have their own sort of specialists there. So you get managers and partners, but there's no shame in asking for specialist help if you're not sure about something. Now, companies, do they normally want to disclose more or less? Less. However, and I would always have said less, but there's been some recent fact-finding and investigation done, which has found that when companies have really juicy information in the note disclosures that they perhaps don't want anybody to read, they'll actually start disclosing about a whole lot of stuff that's also not relevant, so that they can create extra filler to almost hide important disclosures. So one of the things that is being looked at is sort of like a ranking of disclosures. So there are some companies, and normally note 1 would be revenue recognition. Note 2 is related to cost of goods sold. There are a few companies now who are starting to reevaluate how they do their disclosures, and things like, the riskiest item, maybe intangible assets, in some companies has now become note 1 because it is the one that they want shareholders to look at the most. So there is some rejigging. There's no specific formula as to what order the notes to the accounts and disclosures should be in. And we'd always followed for 90% of firms a really traditional method, just by line item within the income statement and the balance sheet. But we are seeing a little bit of a trend toward disclosures being ranked by importance. Most critical that we think shareholders might be most interested in coming out in the first set of disclosure pages, and then less important information, more standardized information at the back. So what do we have to do for contingent liabilities? What's a contingent liability? So I sometimes call them maybe liabilities. And the issue is that a contingent liability is a potential future obligation. So it's not guaranteed, potential future obligation for an unknown amount from something that has already taken place but are conditional on a future event. Okay? Now, obviously contingent liabilities do not go on the balance sheet because we have no idea whether it's a concrete liability or not, whether there's certainty. So you only should record liabilities that you know you're going to incur. However, contingent liabilities must be disclosed in the notes to the accounts. All right. So we have to see if we can identify, are there any contingent liabilities? Should they be recorded? And then the big question for us, how much should be reported as a contingent liability? Okay, so there could be all sorts of things. Legal action for anything is usually the most common reason why we might have a contingent liability. You might have a tax dispute with the tax office in which you know that you're going to have to pay some form of tax, or you're disputing whether you have to pay tax and you're waiting for the outcome. There could be warranties and potentially legal action related to a product warranty. What company has made a product recently that's not doing so well? Samsung, yep. So certainly there, if I was auditing Samsung, I'd be looking at, well, how much money have we put aside for warranties for the Note 7, which they've decided they're not going to make anymore because they can't figure out how to make it without it catching on fire. But is there any legal action? Was anybody seriously injured from one of these phones that means that they might be suing for, loss of working income or trauma? I can't pick up a mobile phone now because I've been so traumatized because my last one blew up in my hand, and that's going to affect me for the rest of my life if I can't use a mobile phone. So we need to think about legal action. Notes receivable discounted and unused balance letters of credit is not that common, but the other one that's common is a guarantee of the obligation of others. So this is quite often if you have a parent company and a parent company goes guarantor on a loan for a subsidiary. If the subsidiary can't pay, then what happens is that the parent then has to pay the balance of the loan. Sort of like if you wanted to buy a place and you couldn't afford it, so your parents guaranteed your home loan. They're saying, well, if my son or daughter can't pay, then the parent will front up the cash. So that needs to be down as a contingent liability. You could have contingent commitments, an agreement to buy something in the future, though these create less of an issue. But the most common way that we find contingencies is by talking to management. What sort of contingencies do you have that we need to consider? We might see if there are any ATO for companies in the news. These minutes of meetings are going to be board minutes. Right? When you have significant lawsuits or product warranty issues, they are going to be discussed at the board level. So that might help you identify some things and see if they come up in the accounts. And the other one was analysing legal expense. So if a company spends big dollars on legal expenses, but they say, we don't have any lawsuits, you go, well, hang on, why are you paying all this money? What's going on? So analysing legal expenses is one thing. Now, the other thing that we can do with legal is to actually ask the lawyers themselves. And this does say external legal counsel. There are some instances where some clients will have in-house legal counsel, where they will hire their own lawyers, or they have their own legal team. That's probably becoming more and more rare now. Most people will outsource to a big firm because it's usually slightly cheaper, and then they can get specialist advice because you might have patent issues, you might have contract issues, you might have mergers and acquisitions, but typically in-house legal counsel is quite small and they're not experts on everything. So most people will use an external legal firm that has lots of different departments where you can call on people in the area that you need them for. So this is so important that we actually have our own ASA for it, ASA 502, about considerations for legal claims. And we ask for something called a representation letter. And a representation letter is really just a form of confirmation, right? Where the auditor says, management, can you please write a letter to the lawyer? So management will write to legal and they will say, dear legal, we give you permission to disclose to the auditor information about the legal cases that we're currently involved in. And then that is sent directly to the auditor. Why do we want it sent directly to the auditor? Yep.
To approve, permission for the auditor to look into all the legals.
Yeah, well, it would be to make sure that the legal knows that management have approved. Rachel? Yes. So the thing that we're trying to do by having it sent direct to us is to minimise manipulation. All right. So that's the reason why we want them to get confirmations. Always confirmations go directly to the auditor to minimise any manipulation. Now, some legal counsel are likely to be reluctant, all right, because they claim they don't know anything or they don't want to give a professional judgment or opinion. They may have questions about confidentiality, but what we say in those instances is, well, hang on, we've actually signed a confidentiality agreement in our engagement letter, okay? So engagement letters contain a confidentiality clause, all right, in which we will not make disclosures without the client's permission or under instruction by the court, okay? And that's where the last one comes in. Communication is not privileged. So what happens is the communication between the lawyer and the client is protected by legal privilege, right? They don't have to tell anybody what they said to each other. However, the communication between the lawyer and the auditor is not subject to legal privilege. So if the court instructs the auditor to disclose what the lawyer said, then the auditor must be forced to comply. Whereas if the if the court said, okay, client or lawyer, what did the other person say? Then the defense there is, well, we refuse, the legal defense is we refuse to give that information because it's covered under legal privilege. Just like there's medical privilege between the doctor and the patient, they don't have to say anything, then that same level of privilege also applies for lawyers and clients, but does not apply for auditors and lawyers. All right, this is probably the hardest topic for this week. All right, and so I'm going to give you a little bit of an overview, then I'm going to send you off at home to watch a 12-minute video and some examples in preparation for next week's quiz. Now, an important note here, the slides for this objective have been rewritten in accordance with guidelines from ASA 560. Some content does not directly align with text. Okay? Students should always follow the auditing standards as the primary source of guidance. All right? So if your textbook ever conflicts with the auditing standards, always go with the auditing standards. Those are the most up to date there. So we're going to use ASA 560 here. Okay? It says, what is a subsequent event? And there are really two types of subsequent events. The first one is those events that are going to have a direct effect on the financial statements. All right? And so these could be things like a debtor goes bankrupt after the end of the financial year. The question then becomes, how does this affect accounts receivable? All right? We might settle a lawsuit, and then we need to adjust our liability for payment of that lawsuit, or if we sell equipment. So there are direct effect subsequent events, and there are ones that have no direct effect, but where we disclose, where we say, look, don't change anything in the numbers, but make additional disclosures. Like, the most common one, you count inventory at the 30th of June, and then on the 15th of August, a fire burns down your entire factory. All right? Or you're in the United States, a company in the United States, and at the 30th of June, there were no issues around, property, plant, and equipment or inventory. Then at some point, the hurricane comes through, wipes out your entire business, and you say, well, hang on a second. It isn't going to affect my financials this year, but it is going to affect how we interpret future information, okay? So non-direct effect transactions are usually things related to the future. So I'm going to show you here the abstract from AASB 110. This is not in your slides, I added this just this morning. But this comes straight out of AASB 110. The following terms are in this standard. Events after the reporting period is anything that I discover, so we discover news or an event after the end of the financial year. Okay? And then they fall into two types of categories, which was the two types that I just mentioned before. Evidence of conditions that existed at the end of the reporting date, and these are our adjusting or direct effect conditions, and conditions that arose after the reporting date, which are our disclosure and no direct effects. Now, if you're looking at other textbooks, quite often these adjusting events are called type 1 issues, and non-adjusting events are called type 2. Now, the terminology I tend to use is based on, that one. I use the terms adjusting and I use the terms non-adjusting. Okay. Now, the reason I use the words adjusting and non-adjusting is that they are specifically contained within the standard, whereas the text uses the term direct effect and no direct effect, which I would prefer to have alignment with the standards, because then that's really clear as to what I should and should not be doing. All right. Now, the textbook doesn't actually, this is not from the textbook, but the instructions in ASA 560, and ASA 560 is the relevant auditing standard, and next week I'm actually going to tell you, if you don't have the auditing handbook, I'm going to tell you which auditing standards to print and bring into the exam as well. But ASA 560 is going to be one of those, and it says my instructions on what to do, because it actually says, if you find something in period X, do this. If you find something in period Y, do this. If you find something in period C, do this. So it's actually really straightforward, but it breaks it into 3 periods. Period 1, anything that you discover during the audit before I sign my audit report, has some very specific rules about what to do between adjusting and non-adjusting events. All right. Period 2 is between when I sign my audit report and when the client releases the full financial report. All right. Now, in textbooks, often the examples given here are like, you sign the audit report in August and it gets released in September. That is not how it happens in real life. In real life, this period is usually 1 or 2 days. It's a very, very small window between when we would sign and when it goes out to the public. So in this period, there are, again, instructions on what to do with adjusting events and non-adjusting events, and the instructions are different to period 1, different things to do. And then in period 3, after the financial report is released, if we discover something here, then, again, we have a third set of instructions on what to do, okay? Now, for me to go through all of those instructions in the lecture would probably take us about 20 minutes. So what I'm going to get you to do is I'm going to get you to watch a video on UTS Online, a subsequent events video, and then most students end up, I draw this big spider diagram which says you start here and then you have all these different choices of what to do and different outcomes and things. So you have this big diagram within the YouTube clip that shows you what to do. So follow the video. It's really self-explanatory. And I don't know why the little flow diagram that I draw is not in the back of the standard, because it's one of the best things, and it's probably one of the most watched videos that we have on YouTube. I've had people who were studying, for the English qualification, and even people who were studying for the CA and the CPA who said, why isn't this in our materials? So watch the video to know what to do in each situation. There's also in the videos, there's a second video. So the second video gives you some worked examples. All right. And it shows you a method for how to handle the questions. Okay. It's pretty straightforward, and once you've got the method down, it's pretty difficult to make a mistake. But I would make sure that you can do that for next week's quiz. All right, really, really, really critical. So once you've got the video worked out and you've looked through the work examples, that's great prep for next week's quiz. A lot of students will often even redraw out the little decision diagram that I've got. That's a really good one to have in your notes so that you can follow that through either in the quiz or when it comes to the final exam. So how do we gather evidence on subsequent events? A couple of different things that we can do. The easiest thing is we say management. Has anything happened after this year that I should know about? Because they are supposed to disclose any subsequent events and we check them. When I already talk with my lawyers previously about my contingent liabilities, I might also ask them any new lawsuits that have started after the end of the year that we might need to know about. The other thing, minutes from meetings, from board meetings that happen after the end of the financial year. One that's not on there, you might look at newspaper articles. And when I say newspaper, I mean you might look online. You might not look in a physical newspaper, but I still say newspaper article. So news articles can often also give us information. So right up until JB Hi-Fi announced that they were buying the good guys, there was lots of speculation. They said we weren't buying the JB. They vehemently said in press releases, we're not buying them, we're not buying them, we're not buying them. We've bought them. So the news can often give you some good information. A subsequent event could also be something like, let's say you're a company that makes beer, okay? Most people does everybody drink beer? No? Wine? Right, so say you're looking at a beverage manufacturer of some sort. And I use beer because I know a lot about the production of beer. And so you have a beer manufacturer and certain things go into beer. Water, barley, hops, which gives it bitterness, all right, and yeast, which is what creates alcohol. Same yeast, similar yeast that goes into bread, though I would not recommend using bread yeast to make beer. It tastes really weird. But a few years ago, there was an issue in that there was a world shortage of hops. So hops is what makes beer bitter. It's the thing I don't like about drinking beer, it's the bitterness. But there was a world shortage, and some of the beer manufacturers had to put in an extra disclosure into their accounts saying, well, we need this key ingredient to make beer. There's a worldwide shortage caused by some sort of natural disaster where most hops are grown. So there's a possibility we may not be able to make the product to sell in the future. So if you have something big like that come up, then it could be a really big issue. There was concern that with the initial outbreak of Ebola, if they couldn't contain Ebola, the world's chocolate manufacturers were very, very concerned because West Africa, which is where the Ebola outbreak was centered or originated, is also the hub of the world's cacao bean trade. So that's where most cacao beans are grown, and if the area needed to be quarantined because of Ebola, then those people couldn't go out and pick the cacao beans, and then the cacao beans couldn't leave Africa to go to places to be processed, to be made into chocolate. So, you know, if you probably didn't think I could get the words cacao or chocolate and Ebola in the same sentence and relate it to auditing, I've done it. But you need to be really aware of what's happening in your client's industry. Yeah. So it could be really big things, could be really small things, but keeping an eye out for your industry is always really, really important. You know, I think, was it Donald Trump says, I'm going to bring jobs back to America? But then a lot of the clothing and things that Trump makes are made in places like Mexico and the Philippines and China. So I don't know whether, you know, if he wins, if he's going to have to issue a subsequent event disclosure that says, okay, costs are going to go up because I now have to relocate all my manufacturing back into the United States. Because, you know, if he has stuff being made in Mexico, it's not going to get past the wall that he ends up putting up. So we have to really think carefully about what sort of things could be subsequent events. It could even be changing government policy. I'm going to add one up here. Change in government policy. All right. So if the government suddenly decided that coal seam gas, which is, there's been lots of controversy about fracking, which is a type of mining for coal seam gas in suburban areas. If the government said, okay, we previously had allowed fracking, we're no longer going to allow fracking anywhere near houses or schools or hospitals, etc., then that might affect the ability of some exploration firms to be able to actually live up to the expectations that they set their shareholders. So government regulation and government policy could be really important as well. How are we doing on time? Okay. So what do we do in the final stage of the audit? We have to go back and we have to do analytical procedures. And I'm going to use the word again, because remember, we also use analytical procedures. Hang on, I'll type this in rather than write it because it'll be easier. So we use APs at the beginning of the audit to do what? Oops, I can't spell. The audit to identify accounts or ratios at risk of misstatement. Oh, let's make that a bit smaller. Okay, so at the beginning of the audit, we use analytical procedures to help us decide, is there something that looks like it's moving at the wrong rate? Okay, so if inventory turnover starts to slow, or if days in receivables starts to creep up, then we say, well, what could be going on? And a common example that I always give is in relation to sales and cost of goods sold. So let's say at the beginning of the audit, sales was going increase by 15%, but COGS only increased by 5%. All right. So So that's at the beginning of the audit. You say, oh, sales are up 15%, COGS up 5%. That doesn't look right because I know my debits and credits means COGS and sales should increase at roughly the same rate. Yep. So at the beginning of the audit, I say this is not moving in the same way that it's supposed to be. I go out in the audit and I find that, oh, there's been some fraud. Some salespeople have double recorded some of their sales to get their bonus. All right? So I think, oh, that's pretty good. Then I go back and I look again. And when I do it the second time around, I find that sales is up 10% and cost of goods sold is up 5%. All right? So I've eliminated some of the increase because I found some fraudulent duplicates. At the end of the audit, I do my analytical procedures again to act as my safety net. Right? This is my last chance to determine whether any unusual fluctuations are still present. And if there is something that can't be explained, I say to management, look, did you guys change prices at all? No. You say, well, did you change manufacturing? We haven't found any evidence of a decrease in per unit manufacturing costs. Well, if you can't find an explanation for this gap, then there's a potential that there are still misstatements that need to be identified. So this is your last chance to catch something before the financial statements go out to the public. So really important to do. So at the end, I do these final analytical procedures and you repeat everything you did at the beginning. The next thing that you do is that you also go, and look at going concern from ASA 570. Okay? Oh, and I just realized, I think I have an error here. That's ASA 520, I'm pretty sure, analytical procedures. All right. So you have to go look at going concern. What is the going concern assumption? Company will be able to pay their debts as they fall due. Okay. Now, theoretically, under the going concern principle, that time period is forever. They'll be able to pay their debts as they fall due forever. Do I want to give an audit opinion on a period of forever? No. So from an audit perspective, I say this for 12 months from the date I sign the audit report. All right? Not from the date of the end of the financial year, but from the date I sign my audit report. I think, based on today's information, that the company will continue for the next 12 months. All right? Now that means that if something changes dramatically that you couldn't foresee and the company does go out of business, it's not your fault. All right? But if you evaluate going concern, you look at their cash flow and a whole range of issues and you miss something and the company does go out of business because you've missed it, then you have breached ASA 570. So what comes to mind in this instance is lots of companies that looked financially healthy before the subprime crisis, that after subprime suddenly had all these issues, and we couldn't have foreseen that that was going to happen. Now, this diagram comes out of the appendix for ASA 570, and funnily enough, when I've actually, international viewers who are watching the video will often say, this is not in the international auditing standard, and I don't know why, because this is exactly what the standard says to do in lots and lots and lots of paragraphs in a nice little easy flowchart. So this is one of those ones that I would certainly print out and have with me because it gives very clear instructions onto what the auditor should do if we think there is a going concern issue. And they use a key term about something called let me just write this down, material uncertainty. All right? And a material uncertainty is some sort of event or action that may prevent the company from paying their debts as they fall due over the next 12 months. All right. So what we have to do is we have to evaluate the company. Are there any material uncertainties? If there is a potential for a problem, the company must disclose that. Management under AASB 110, sorry, not AASB, what's the AASB on going concern? Mental blank, I can't remember. The AASB on going concern says, management, if you think there's a problem, then you need to make a disclosure, all right? And if they do make that disclosure, then we actually say, good on management for making that disclosure, and I actually reinforce that information to shareholders as well. So I say, everything is true, just be aware there are some uncertainties that may affect the company going forward. Shh. So most companies that do have an uncertainty end up turning it around. It's only in a few circumstances where having one of these material uncertainties does result in company failure. So having a read through this flowchart's a really good plan for next week's quiz. Now we also have some standards on written representations. And we have a standard for written representations because sometimes some evidence that we get is only verbal. As much as we try and get documentary evidence or evidence from outside parties or confirmations, sometimes the only thing we can rely on is management telling us something about an issue. So we get something called a management representation letter, which is essentially them saying that when they've given us information and they've told us stuff, they're telling us the whole truth and nothing but the truth. They're not hiding anything. Okay? So the letter makes them do a few things. They say, oh look, yes, we are responsible for the financial report, choosing the accounting policies, here are some issues. But the biggest thing is that the written representation letter confirms verbal evidence. Okay? So this in itself, that letter, becomes a piece of evidence upon which we rely. All right? So that's management saying everything I've told you is true. It's sort of like a statutory declaration in essence for a whole lot of verbal information. So management give us this. They must give us one of these by law. All right? If management refuse, then what we're going to do is we're going to give them a modified opinion. All right, we're going to say, hang on, we do not have sufficient appropriate evidence. All right. Okay. So after we've done going concern, we've looked at subsequent events, we have to go back and we have to do some checking. So one of the first things we check is that, number one, we've done everything on the audit program. Did we test every account? Did we test every assertion? Have I got evidence for everything? Then I summarize the misstatements. All right, I have a list. You have a little schedule that says, here are all the misstatements. Here are all of the dollar amounts that we think we would like management to change. Okay? And we look at the disclosures. Is everything disclosed in accordance with my AASBs? Are they doing the right thing? Now, we also have to, and this happens continuously. So while it does say here, this is something we would do at the end, I would be reviewing the work of inexperienced staff continuously throughout the audit. Every time they've done a task, at the end of the day, as their senior or their supervisor, I would check it. Because I'd rather check it earlier and have them fix a problem than get to the end, check all of them and go, oh, we have some problems. So the working paper review does happen continuously. We want to make sure we follow the auditing standards. And then we also have independent review. So this is usually done by a partner from within the firm, but not on the audit. Still has the same industry experience, but it's just a fresh set of eyes. Have you ever done an assignment where you've looked at the assignment for so long that you miss a really important mistake that you've made and you only notice it after you've handed it in? Yep, you're like, oh, that's totally the wrong word. I meant to change that. So the issue with the audit is that the auditor can become so immersed in the audit that we might miss something or we might misinterpret something. So we get a different partner to look at the same evidence, look at the same work papers and say, does everything seem okay? All right. Now, that partner would have the right industry experience, so we wouldn't, have a pharmaceuticals partner review a mining firm. We'd have them in the same industry, but that gives us an independent check. And that is all about minimizing our audit risk. All right. Minimizing the risk we get sued for giving the wrong opinion. So we always ask for second set of eyes. Okay. Sort of like the blind taste test on MasterChef. When you're going for the immunity pin, the judges who are going to eat the dishes don't actually watch the contestants cook. They go off and they do something else. The contestants cook their meals and then they have that blind tasting, sort of like having that independent check. Now, in evaluating the misstatements, the big question always becomes, which adjustments am I going to request management make? Now, a note here, this is not covered in the textbook. I don't know why it's not generally covered in audit textbooks. Every time I review an audit textbook, I always say, please discuss negotiation of misstatements. Because it never happens that we have an entire list for the client and we give them to them and the client goes, yeah, sure, I'll change all those. Right? Doesn't ever happen. They usually say, I don't want to change any. Because what they think is correct is what they give you in the first place, and that probably maximizes their own personal compensation plan. So, ASA 540 says we have to evaluate misstatements. So we find misstatements we believe are material, and the question we have to ask ourselves is which of these misstatements will have an effect on the users and their decisions. Now, this is difficult for a number of reasons. How many different sorts of users are there of the financial statements? Heaps. All small, large, with differing risk profiles. Do they all make the same sorts of decisions? No. So I have to try and think about all the potential users and all their potential decisions and say, well, hang on, for this misstatement, is this important to shareholder group A, shareholder group B, shareholder group C? And remember, that misstatement could be a number or a disclosure. So some groups might be interested in the number being more accurate. Other people, like share analysts, are interested in disclosures. They'll have a quick look at the numbers, but anybody who does financial analysis for a living will say the interesting information is in the notes to the accounts. So that's where they want to look. So we get stuck in a bit of a tricky situation where the audit partner negotiates with the client about what adjustments they're going to make and what adjustments they're going to refuse. All right? And that's not an easy task because the client wants what they had originally. You want what you think is the appropriate amount, and you need to come to some agreement, but do it in a way so that the client isn't so pissed off that they're going to fire you and not hire you back next year. So it's difficult, right? We're supposed to be independent, but here we are now negotiating with the managers of the firm. So factors that affect the client negotiation. There's a significant body of academic research on this, and if you're interested, Professor Ken Trotman at the University of New South Wales is probably Australasia's foremost expert on audit and negotiations. And He's done a lot of work in the psychology of negotiation, but the sorts of things that Ken and his team of international researchers have found is that things like negotiation skills play an impact. To the point where I think a number of years ago, Ken was actually teaching partners negotiation tactics and negotiation skills. So most audit firms, when you become a partner or you become a director, will send you on a negotiation skills training course to learn the best ways to negotiate, rather than, this is what I want and do it, the Donald Trump method. Is there some other way that you could come to an agreement? So negotiation skills, there are different negotiation tactics, just like you've got different tactics in chess. There's different ways to open the negotiation, to approach the negotiation. Even the language used when you phrase misstatements could have an impact. The firm's reputation as an expert. If you happen to hire an audit firm that is the biggest leading expert in your industry, you are much less likely to argue against that firm about not making the adjustment. Oh, well, you're the experts. Okay, we'll go with what you say. Oh, you're a small firm trying to make a big name for yourself. I'm going to push back and say I want what I want rather than what the auditor wants. Whether the auditor has let the misstatement slide in the past. This is often something that I get, not in terms of misstatements, but especially with supplementary exams. Students will come to me, Amanda, I failed. I only need 15 more marks. Can you just give me 15 more marks? No, right? Oh, in my finance subject or my management subject or my marketing subject, I failed, but my coordinator is going to give me a supplementary exam. Can you give me a supplementary exam? Well, no, right? So if you've let something slide in the past, they're more likely to push the next time around. I made this mistake with my son the other day. He found a container of Ferrero Rochers, which are these chocolates. I love these chocolates. And he said, Mummy, can I have one? This was before dinner. I said, no. However, if you finish your dinner, we can all have a chocolate, all right? That was my solution to him having a complete and utter meltdown while I was trying to cook dinner. And then that came back to bite me in the ass because the next day, he'd eaten all his dinner without me asking, and he said, Mummy, I've eaten all my dinner. I would like a chocolate. So now I'm stuck. I'm like, well, okay. And I said, well, that was yesterday. And he goes, yes, that was the rule yesterday. Isn't that the rule today? And I said, well, no, because chocolate is only a sometimes food. I don't tell him that it's like an all the times food once he goes to bed and we eat chocolate while he's asleep. But I tell him only a sometimes food. So in that instance, I had let the misstatement slide. I'd created a rule in the past, and then that rule had come back to bite me in the future. So you want to be really careful. What did you let pass last time? If you were perhaps a bit unethical last time, then the client might say, if you don't let this misstatement pass this time, I'm going to report you to ASIC because you did the wrong thing last time. And if you're not going to do it for me now, I'm going to threaten you with sort of like a mutually assured destruction. Client audit committee. If you've got client audit committees that are really great at standing up for shareholders, they're more likely to push for misstatements and the level of risk. So on low-risk clients, auditors are more willing to let things slide or let misstatements go unadjusted than in clients that might be very high risk or very high profile. All right. So what adjustments should be made? And the key issue, how much should the audit adjustment the auditor push for? So let's hear a scenario. We believe that the most accurate balance requires an adjustment of $125,000. If materiality is $75,000, what's the minimum adjustment the auditor would accept? What number do we think? 75? 50? All right. So theoretically, we look at it like this. I'm going to draw a little bar graph. All right. So the adjustment we want is 125,000. Okay. Materiality is 75,000. So I'm happy with any misstatement smaller than this. So theoretically, the adjustment will be the difference between these two, which is 50,000. Now, in terms of strategy, I wouldn't really be advertising this number before you go into the negotiation. Otherwise, the client is just going to give you this size gap every single time. Oh, yeah, I'm not going to go more than 50,000 in adjustment. And you'd be like, well, okay, so technically that's at my materiality level, I'm going to leave it. But you might want to negotiate. Oh, yes, question.
What if the required balance for the adjustment is 150,000, so it's outside of that?
Yes, so what if we said, if this number was 150, then this number would become 75. Yep. Is that what you mean when you said 150?
It's above that 150,000, so it's like outside of the normal bracket.
Well, you would decide what this number is. All right? Your audit testing tells you here is how much should be adjusted in the accounts. The ideal optimal adjustment. There's the materiality level, and the difference is always going to be the minimum that you're willing to accept. Yep. But you could come up with some different tactics, like a common one is that you walk in and you give the client a list of like 150 misstatements. And you say, oh, okay, well, how about for misstatement number 2, if you give me the maximum adjustment, I'm not going to worry about these ones down here, which you weren't worried about anyway because they were below the level of materiality, but you could use them as a bargaining chip, all right? Especially if the client doesn't know what this number is for that particular account, okay? So there's always, this is like the throw in the free steak knives type of approach. That's also an option. What about communicating effectively? Well, the reason we want to communicate with management is we want them to hire us back next year. So there are a number of things we tell them about. We tell them about whether we found any fraud, if we found any deficiencies in their internal controls. We will reinforce our independence requirements, because at the beginning of the audit, we already told them, we're independent. And we prepare that, I just dropped my pen. Okay, we prepare that in something that we call the management letter. Okay, this is a letter from the auditor. So the management letter is from the auditor to management, whereas the management representation letter is the other way, okay? So it's usually a written report, but one of the most common things that we also do is we also often have a presentation. Here are the issues, all right? Why do we have a presentation? Because it's often clearer to demonstrate or explain to somebody the report rather than asking them to read it, because people tend to skim read reports. The other one is that the presentation also allows you to sell other firm services. Oh, we found this issue where there's a suspected fraud. We can't help you on the audit team with that. However, have you heard of Firm A's forensic accounting service? We can put you in touch with them at a discount to get them to do the forensic investigation. Or, did you know you have these problems in internal controls handling cash? Did you know our business process experts can help you design a new policy and procedure around this? So the presentation not only helps convey information, but is about selling. All right? And that's what the firms are all about. Obviously, the audit is the foot in the door to sell the clients lots and lots of other things. Human resources, legal services, tax advice, whatever it might be. We also will communicate with the audit committee about the audit, and we'll tell them about the adjustments, and we'll tell them if management are refusing. So if management are refusing to adjust, we will tell the audit committee that, and the audit committee sometimes can have the power to compel management, look, we don't want to receive a modified audit opinion. I know you're quibbling about these adjustments, but from the shareholders' perspective, we think this is better in the long run. All right, a recap of audit report. We should already know all this. ASA 700 is the basic unmodified and unqualified So you could use the word unmodified, you could use the word unqualified audit report. This is the big tick, right? Everything looks good, everything is true and fair, everything is in accordance with the AASBs. The audit report has a slightly different layout now compared to your textbook. So note up here is different from the textbook layout because ASA 700 has been updated. The auditor's opinion is now the very first thing that shareholders will see because we want to make it very clear. We don't want people to start reading the audit report because previously all this was at the beginning and they would just get sick of the legal mumbo jumbo and they go, oh, I'm tired of reading this before they even got to this section, okay? So audit opinion is now right at the very top and key audit matters is a brand new ASA, ISA that is coming in next year that will be critical. So when would we modify our opinion, all right? This is when something is not true and fair. So we always start with, number one, we ask this question, why would I modify the opinion? Either misstatement or disclosure incorrect, or inability to get sufficient evidence. Can't get enough evidence under ASA 500, right? So you make your choice. Is it this one or is it this one or both potentially? And then question number 2 is the severity of the issue, all right? So is it material but not pervasive? And obviously we have Norman, the non-pervasive slug. You put Norman on the financial statements, he's not going anywhere very quickly, right? Just in one area. Or we have Perry the pervasive octopus, or if you put Perry down and all his tentacles, they reach into lots of parts of the accounts. All right? So in the final exam, if you can remember Norman for non-pervasive and Perry for pervasive, and then you come up with one of these 4 audit opinions. Now sometimes, we're almost there, we want to add emphasis for information that is already in the report, right? Company has a going concern issue. There's a subsequent event or a contingent liability that creates a significant issue. And I say, I think it's really important for the shareholders to know about this. Yes, it's buried within the annual report, but I want to wave a big highlighter over it and say this is key to know up front. So I put that in an emphasis of matter paragraph under ASA 706. All right, and I give some extra information. I still say financial statements are true and fair, but I say, but also just remember to consider this information as well. All right, this can be added to any sort of report. So this is like going to McDonald's and you order your meal and you can tack a sundae onto anything. The emphasis of matter is like that. All right, so what sort of things could we add emphasis of matter for? If there's some uncertainties related to going concern or contingent liability, if we've got inconsistent other information. So let's say the company in the front glossy part with all the pictures and the words of the annual report says, yeah, the company's making a profit, but the financial statements show the second year of loss. You would say, shareholders, management are telling the truth in the financial statements. Just be aware that they're telling a different story up the front. That one almost never happens. Most emphasis of matters come from here. The other one, which comes out of ASA 560 in relation to subsequent events, is if we have to revise the financial report. That happens sometimes if you issue the financial report and then you go, uh-oh, there's a boo-boo. We made a mistake. You recall it, so you tell everybody, don't look at the first one. You issue a second version of the financial statements and a second version of the audit report in which we say, hey everyone, just be aware, this is not audit report number 1, this is actually second version. Okay, so that's what it means by revised. Okay, ASA 701, this is really critical, and this is going to be probably the biggest issue for auditors, I think, in the next couple of years. We'll start for companies 31st of December, and it's about having transparency over decision making. So the auditing standard says, in some very nice words, we shall determine matters that required significant attention in the audit And we shall disclose those as key audit matters. So what sort of things could require more audit attention? Areas of higher risk, ones where there's significant judgments, including management judgment and estimates, or there's the significant events or transactions could have occurred. All right. So they're saying in these areas, you need to disclose to shareholders exactly how did you tackle these areas? What sort of things did you consider? What were the big hurdles that you had to do? So the communication there says that we have to communicate a couple of things. We should have, the key one, how these matters were addressed. Oh, I'll do that in green. I don't like red. How these matters were addressed in the context of the audit. All right. Now, at the beginning of semester, we did look at some examples. QB Insurance, Cochlear Limited, ASX, where they gave us very detailed instructions and information on, oh, well, this was an issue, we had to look at this estimate, management had to make this judgment, which relies a lot on this information, which is very speculative. But the big issue that's going to face the industry is what happens if all of the key audit matter disclosures start to look the same, all right? We are at the point where audit opinions are pretty much standardised except for what is written in the basic opinion, because legal obligations mean we want to try and protect ourselves. So there is some risk that suddenly all KAMs might look the same and not have specific enough information to help us understand what the auditor was thinking. Now, one of the reasons why we do this is because if the auditor has to justify their decisions and how they've made those choices, then hopefully they will reassess and reevaluate. Are we doing the right thing? Have we followed the auditing standard? Is this the best way to do it? So it's all about a process of reevaluation. Is there a question up the back or are you just stretching? Stretching. All right, awesome. So key takeaways for next week. Number 1, watch the video and know how to deal with subsequent events. Number 2, know how to deal with going concern issues. And number 3, know about audit opinions. So next week, we still have a lecture. Bring your internet-enabled device. There'll be a chance to win prizes. We'll have some competitions next week as well for our very last class. So thank you very much, everybody.